Welcome to the Week in Market. So I'm Chris Leyland, I'm Director of Investment Strategy here at True Potential, and I'm absolutely delighted to be joined by Matt Henderson. So Matt Henderson is a portfolio manager here at True Potential. What we're going to do with our Week in Markets is discuss everything except for the UK election. So we've just released a podcast which will give you information around how we're thinking around the UK election and what does that mean for your investments. But let's go into other stories this week, and maybe let's start quite globally, Matt. There's been quite a lot of survey data out this week.
Yeah, so we've got, as you've mentioned, Chris, survey data in the form of PMIs, and as we know from previous videos we've done, that covers the manufacturing side and also the services side of the economy, and that's come out across different regions across the globe. So we've had Europe, the UK and the US all release their data, and I think broadly what we can see when we're looking across all those regions is the continuation in the strength that we've seen in services before, but also manufacturing being a lot weaker than what we're seeing in the services side of the economy.
I think one of the morning markets that I did was just on the ISM data in the US. Do you want to just bring that to life a little bit?
Yeah, so it's mostly focused on the services side of that ISM data. As we know, manufacturing's been weaker as we've covered, but we're starting to see signs that the US growth story is just starting to moderate from where it has been. So moving more towards a trend, not an alarming level of growth. We're just moving away from those elevated levels that we've seen post-COVID. So when we've looked at the underlying series that make up the ISM, there's a few different components. So there's things like employment, business activity and new orders. We saw those components move lower. So the way these indices work is if a reading is below 50, it indicates contraction, and that's where those readings have moved to. But the final component that we haven't mentioned yet, Chris, is the prices paid component, which is sort of an inflationary type component, and that's remained sticky, similar to what we've discussed in other videos around the US where inflation has remained sticky. So that's still above 50, so continuing to see stickiness in services prices. So, you know, we're continuing to see trends that we've commented upon in other videos in the US.
Excellent. Maybe let's stick with the US a little bit. And we had the Federal Reserve minutes that came out this week. Always really interesting read. Just within that, you know, what are maybe some of the key points that you found interesting?
Yeah, so I think the Fed are picking up on points that, you know, you and I and the rest of the investment team have picked on within the US. We're starting to see participants within the FOMC comment that they are starting to see signs that growth is cooling or starting to moderate, although, you know, those are probably seen as positives by the Fed just in terms of its inflation battle. And, you know, they've used terminology or spoken about how current policy is viewed as being restrictive, so ultimately that should help them in their inflation battle. Other things that they've mentioned is that, you know, inflation, although it is high, they don't actually expect it to hit the target until at the earliest, the end of 2025. So I think that reinforces their stance of why they're looking to keep interest rates where they are and not actually looking to make any cuts earlier, because essentially they're worried, Chris, that if they do cut interest rates, that might fuel another round of inflation, and then they're going to have to go and, you know, raise interest rates and make policy restrictive once more. So I think the Fed are just being cautious around actually, if we do cut interest rates too early, what could that mean for future inflation outcomes?
Excellent, thank you, Matt. Maybe the final piece of data, and I think this has literally just come out today, is what we call a non-farm payroll data. So basically looking at employment in the US. Do you want to just bring to life, you know, it's a really important piece of data. I know a lot of investors have been waiting for this to come out. Just your thoughts around that.
Yeah, well, it's also one of the things that the Fed in the minutes were commenting on, just looking at actually what is labour market data going to look like in the future, and just linking where we've seen wages to where wages have been elevated, and have linked that to price inflation. So what we've seen in the non-farm payrolls, which was released about an hour ago when we're recording this video, is that they've come in higher than expected. So 206,000 jobs added to the US economy over the previous month, and that's slightly higher than what the market had been expecting at 190,000. But What we have seen is actually the unemployment rate marginally ticked up by 0.1%, so that's now 4.1%, and it's the highest rate of unemployment we've seen in the US since December 2021, which sounds like a bit of a scary fact or figure to hear.
But it's still quite low compared to longer term history.
Exactly. On a historical basis where it's still pretty tight, robust labour markets, and it's more just the normalisation following, the strength of employment in the US following COVID. Other bits and bobs that we've seen come out of it is we've seen average hourly earnings. That's just dropped as well. So that was 4.1. It's now moved down to 3.9. So starting to see wages in the US moderate, which back to what the Fed are looking at, that will be seen as a positive because lower wages should hopefully lead to lower price inflation, so get the Fed back to their inflation target. I think within some of the employment data as well, if we look at the difference between public sector employment and private sector employment, continuing to see that theme of growth starting to moderate within the US, where the government sector added 70,000 jobs, whereas the private sector added 136,000. So government was more than the market had expected, private less. So just continuing to see those threads or themes that the US economy is just starting to slow at the margin. But once again, I don't think we as an investment team are seeing signs that that's recessionary. It's more just moving towards a trend level of growth from the elevated levels that we had seen. And ultimately, the important thing for our investors, Chris, is what has that meant for asset markets? Well, equities in the initial reaction to it, marginally higher, and it's mainly fixed income markets where we've seen the response with yields moving lower, so prices of bonds moving higher, and that's mainly just the market thinking we could see more, or the probability of interest rate cuts in the US being higher than what was expected before the announcement.
Excellent. Thank you, Matt. Thank you for going through all of that. Just as a reminder, obviously this is our week in markets. We do also have our separate podcast, which will focus in on the UK election, which has been released now. But we look forward to speaking to you soon. Thank you very much.